Hello, investors. This is Cory Mitchell with TradeThatSwing.com. We're going to look at some of the best dividend stocks for long-term investment. I know a lot of people like dividend stocks. They like that cash flow, getting some cash in your pocket as you hold stock. The problem is a lot of people look for just a high dividend paying stock. They want to see like the 10%, the 12% a year dividend, and that can often be a trap. Really high quality companies often don't pay really high dividends because there's no reason to. They want to use that cash to grow their business. So this looks at a combination of the dividend, but also companies that grow their dividend each year. And what that means is, like, this year you might get 50 cents per share. Next year you get 60, 70 cents per share. The following year you get 80, 90 cents per share. With the idea being that these companies are also growing. So it's the share price over time moves up, the dividend over time increases. So we're going to look at that. And here's a very simple thing: as opposed to just looking at, okay, this company pays a really high dividend yield, I'm going to invest in them. Look at the performance of stocks that simply have increased their dividend regularly. So dividend stocks have tended to outperform the S&P. I ran a scan of all the stocks that increased their dividend by an average of at least 0.4% per year over the last decade, with $1 billion market cap and trade on a major exchange. That was it. That was the only criteria. And look at that. Now, there is a little bit of survivorship bias in here, in that, we're looking for stocks that have been around at least a decade, have $1 billion market cap, and have been able to do this, right? But it still shows, like, wow, if companies can continue to increase the dividend, that is a very positive sign for their business, and more than almost tripled the S&P 500 return just based on that simple criteria. Now, this would include a lot of stocks, so I've narrowed it down where we're just kind of looking at some solid companies that have increased their dividends, that offer a decent dividend yield, at least 1% or more. But I'll show you how that kind of works over time, and we'll look at a couple examples. So here is the list, and I believe there are 19 stocks on the list. And so what we're looking at is we have the dividend yield here. Shareholder yield's a little bit different. So that includes basically whether they're issuing stock or pulling back stock. So it looks like if the shareholder yield's a little bit lower, National Bank may have issued a tiny bit of stock, which then, kind of dilutes existing shareholders, so it drops off a bit. Whereas in this case, Watsco shareholder yield is slightly higher than dividend yield, so they maybe bought back some stock. McDonald's probably bought back some stock because their shareholder yield is higher than the dividend yield. So this is what this list is really about, what we have over here. So we have earnings, their actual earnings, how much the company is making and whether that's growing or not, and the historical 5-year or 10-year average yearly dividend growth. So what this number says is that on average, National Bank has increased their dividend by 8.6%. So if it was a 10-cent dividend, the next year it's almost 19 cents. And then the next year it's going up another 8.6%. And then the next year it's going up another 8.6%. Watsco, 15, almost 16%. Booz Allen Hamilton, almost 16%. So it's whatever you're making as a dividend, that's increasing by 16% a year. If you're getting, $1,000 in cash flow, the next year you're getting 1,160. And think about how that starts to compound out. And if you're holding a stock for a decade and it's compounding at this sort of rate, you're starting to, see huge increases in cash flow. Not because the dividend rate is high. A lot of these will often still end up being around 1 to 2 to 3% a year because the price is increasing, the dividend is increasing, so they kind of stay around that rate. But you, as an original investor, you might have invested when it was originally at 3%, like national bank, but a decade later, your dividends alone are making you 20-30% a year on that original investment. And of course, you could continue to add or reinvest those dividends, in which case you'd be making the capital gains, because this talks about how the stocks have performed. So annualized 10-year return, you can see all of these really good performers. S&P has averaged about 12% a year, and these are slightly higher. And that couple percent over long periods of time can make a really big difference. This is yearly EPS growth rates. This is expected growth rates. I've also factored in that these companies have to have increased earnings in the past or have a steady track record of increasing their earnings, and they're also expected to continue to do it into the future. So S&P kind of average expected growth rate for a stock is about 10% a year currently, and some of these slightly lower, but they're all in the ballpark. Plus we have these other factors that are helping them out, and some are much higher. So here's some additional stats. This is courtesy of Stock Rover, which we're going to look in a second. I'll put a link below, and you can, if you sign up through Stock Rover through the link, I can share some of my lists with you. But what I wanted to show here is just like an example of the dividends. So over here under dividends, so this is just National Bank. This is a Canadian company trading on the Toronto Stock Exchange. But we go back to 2007, your dividend was $1 per share. And back in 2007, the stock was around 28 bucks. So your dividend rate wasn't super high. But you're buying that stock around 29 bucks, and you got $1 dividend a year. Awesome. Now the dividend's up to 4. You can just see this steady increase. It's like every year you just get a little bit bigger dividend. So 4.40 last year will be higher this year, and the stock's now up to $130. So that $4 dividend on $130, like we said, we're around that 3% mark. But if you go back, let me just move my head there so you can see the price back here. But on your original investment now, if you bought around $30, let's say, your $4 dividend, that's a 15% dividend just based on that original purchase. Now I said you could continue to buy that stock, which your average price would increase, but your dividend yield is going to be much higher than this because you've been buying throughout this whole area. You bought some at 30, you bought some at 40, you bought some at 50, you bought some at 60. And so your average price is much lower than the current price. So that $4 dividend, if your average price is, even $60 over the last 10 years, 20 years, your dividend rate is quite large. You're in that like 8, 9, 10% that you want from that, kind of crappy stock you're buying that pays a high dividend. Maybe it's a really cyclical oil and gas name. Yeah, sure, it has an explosion where it goes up, but then it also crashes back 80%. Then, goes back. You get these weird dividend rates where sometimes it's really high and then they drop it. This is more what we want. Just companies that are solid, have solid growth, really steady dividend increases. We can go through these. This one was a special dividend they offered way back then. But you can see just steady increases. McDonald's, really steady increaser. And same thing for all of these. ADP, 1.9%, but also, and just look at the stock performance over time. Like, just really good performers, outpacing the S&P 500. So just something to consider, and this is the list. This is not a portfolio necessarily to just go out and buy. It's basically, I look at these, I go through them, I pick out the ones I want. Maybe they've had a little pullback, or they're breaking out of a chart pattern or something. That's when I'm going to step in to buy them. I'm not just going in and buying all these at once. This is basically my list of ones that I want and that I can go through for my long-term portfolio. And when they're at a spot that I like, that's when I'll pick them up. So your entry, your exit method, up to you. This is basically just a list of stocks that says, hey, they offer an okay dividend right now, but that dividend grows, the company grows, the stock has performed well. We don't know what's going to happen in the future, but these companies have a very strong track record of being able to grow their earnings, grow their profits, grow their sales, and in exchange, they can then continue to increase their dividend. These other stocks where the dividends really fluctuate, maybe they're paying a really high dividend, chances are they're paying out everything, so they can't really grow maybe as much as they could over the long term. And so I like these kind of companies, more dividend growers, as opposed to just a company with a seemingly high dividend, which may be subject to change. Look for the track records like this. So that's your dividend, long-term investment dividend stock list for, when did I update this? Just right around the start of May. So in a couple months, I'll be updating it again, looking at a new list. Generally, they don't change too much, but there'll occasionally be some shifts out. If something shifts off the list, that's not necessarily means it's bad. So for example, these companies, I've cut it off at 1% dividend yield. But for example, Loblaws, or any of these kind of near the lower end, if the stock price really rises more than the dividend increase, these dividend yields might have dropped to 0.9, 0.8. So they'll no longer be on the list, but they're still super solid companies to own, and the dividend is increasing. So, that's fine. You're still going to get that same kind of compounding of the dividend effect over time as long as the company continues to increase the dividend, but they may fall off the list. So that's the list, and happy trading, happy investing.